we had an extremely good year, and just to differentiate here is that when we talk continuing operations, it excludes the footwear and resource services group that we acquired with the Hellaby business. We're there in the process of a sale process, both of them, and we expect that they'll be sold at some point in this calendar year, we hope, but they're underway. So revenue was up 48% on continuing operations, which took us just over $1 billion, and that's not an annualised figure. So if you actually add the extra half a year of Hellaby Auto into that, it'll be sort of well above probably 1.2 million in that sort of region on an annualised basis. Our total reported revenue was actually up 77%. So, and that led to a 51% increase in NPAT on a pro forma basis, or if you add the non-continuing businesses, we're at 71.5. So we're up a massive 64%. Even if you exclude all that and say, well, what about statutory net profit? So that's after all the acquisition costs and fundraising costs of the acquisition of Hellaby, we're still up 46.5%. So whichever way you want to cut it, it was an excellent result and something we're very proud of. EPS up 36%, or on a bottom line basis up 45%, including the discontinued business, 48%, including the discontinued businesses. So we had excellent growth in every single measure that we've got. All our businesses, not just the acquisitions, recorded solid growth. The Hellaby acquisition, especially the auto part, has integrated well, and it's exceeding our expectations. And you only have to look at their result in the 6 months, for the 6 months since we've had them, and you'll see that it is going like a house on fire. And it's exceeding our expectations. And we've also done the optimisation program that has said that over the next 3 years we'll extract another $8 to $11 million in synergies out of it. So it's a great acquisition and it's performing well. Just overall on operational highlights, we've improved performance across every segment. So every segment's sales, margin and earnings are improving. We added 23 stores across Australia, so the Burson Trade Network continues its juggernaut roll-on. And its profit is up substantially as well. We did add eight Autobarn stores. That's not the full story because that was a net figure because we did buybacks of a number of the Autobarn stores as well that don't increase the numbers but increases the number of company-owned stores to the tune that we've now got 25% of our stores in Autobarn are company-owned. And Autobarn's now at 122 stores, more than it's ever had. And that's heading towards a target of 200 stores. Burson's at 160. In fact, today I think it's 161 or 162. And it's well on its way to the 200 that we want to get it to. And as you can see from the continuous results, it is continually improving. The Metcash Automotive acquisition that we did about 2 years ago, we did say we'd get synergies out of that between 8 and 12.5, and it's delivered right at the top end. I mentioned the successful acquisition of Hellaby, and the auto business has got upside from even where it is today. It ran at something like 8% same-store sales in New Zealand and 7% in the specialist wholesale business, and that's continuing today, and we expect to accelerate it. I mentioned the optimisation program. We've also got retail franchise loyalty programs. So for the franchisees in our retail and service, 85% of those stores are franchised. So it's important to recognise that on retail and service, even though it's only 25% of our turnover, and that will go down as we get a full year of Hellaby in percentage terms, it'll go down. It is still a significant part, but it is predominantly franchised, and we know that we are committed to the franchising long term, but we want more company stores within it. And we've given some information on our warehouse program where we think there's significant efficiency benefits to be achieved in that. And that really comes down, and whilst we haven't said this overly loudly, it's a consolidation process that will make us the most efficient in the supply chain and will put us far ahead of anybody else in the industry. And we can do that because we cover the whole industry from the wholesale side through the retail and trade, that by putting it all together will cut down on inventory and will also be more efficient and cut out our costs significantly. So if you just look at the key financial highlights, they're all pretty much, as I'd mentioned, extremely good. There's what we then did, and this is the bit that we'd like to highlight a little bit, like to gloat probably, that when you look at the compound average annual growth rates, they are exceptional since our IPO in 2014. That you look at revenues up compound annually by 35%. You've got EBITDA and NPAT up by over 40%. And then you look at the EPS, it's still up by 34%. So we're not actually just adding top line, we're actually adding value to the shareholder. And that's our target. So, and that's what we intend to try and do. I won't go through some of the individual areas here. In fact, I'll just go back to this one here, which is the actual results versus guidance. We did say that the traditional Bapcor business would do between 57 and 59. We came in right at the top end. And the same goes with Halliby. Even the footwear business within Halliby and TBS, which is part of Resource Services, have performed exceptionally well. And they're continuing to improve. So they are very good businesses. It's not like they're not good. There's a portion of Resource Services group that I can't say that about, but the TBS side is actually a very good business. And I think underlying that when they're eventually sold, the buyer of them will have some good businesses going forward. Now, I'm going to jump right down to our outlook because that's there's a lot of information by segment, but I won't go through those because you can look at those as you want to. So I'll get through this and you get down to our outlook. What we have said is that we expect the next year to be something like the year that we've just finished, in that we'll continue to deliver on business profit growth in 2018. That the year will include the full year impact of Halliby Auto, continued growth in trade and retail. The store footprint, we expect to continue that growth, and that's continuing on, and that we're expecting at the end result to be something around 30% up on our pro forma result for 17 for the continuing businesses. So we expect a very good result in the coming year, or in the year we're now in, similar to what we've been able to achieve going forward. And the other thing that I would add is that doesn't assume anything in any acquisitions. We have nothing on the table at the moment for major acquisitions. We're not looking at anything. Our focus over the next 12 months or so is predominantly on consolidating what we have and extracting the value out of the whole chain. And we think there's significant opportunities in that, as we've said in the optimisation program. So very pleased with the year that we had, as we have been since 2014, and we still think that there's a fairly good road ahead of us.